back to Intelligent Investment Today, the podcast concerned with all things value investing. In each episode, we take a topic from the investment landscape and try to apply the lessons as laid down by the man widely regarded as the father of the craft. Tutor and mentor to Warren Buffett, no less. We are, of course, talking about the late, great Benjamin Graham. In this episode, we're going to approach value investing from another slightly different angle. Rather than examining success, we are going to examine error. More specifically, we're going to be looking at some of the most notable investment mistakes made by Graham's most famous student, Warren Buffett, and ask what they reveal about the practice of value investing. Because investing, as Graham repeatedly reminded us, is not about brilliance in isolated moments. It is about temperament over time. It is about the consistent application of rational principles in an environment that frequently rewards emotion, impatience, and speculation. Even the greatest investors in history sometimes make mistakes. Markets are uncertain, information imperfect, and outcomes are never guaranteed. The real difference lies in how those mistakes are handled, and whether they become permanent impairments of capital or simple stepping stones towards a deeper understanding. So in this episode, we'll explore 5 of Warren Buffett's most instructive missteps and consider how each one reflects, and in some cases refines, the original principles laid down by Benjamin Graham. Because sometimes the clearest way to understand a philosophy is to examine the moments when it was tested. So, as ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Let us begin back in 1993. At the time, Berkshire Hathaway acquired the Dexter Shoe Company for approximately $433 million. On paper, it appeared to be a sound value investment. The company was profitable, had a recognisable brand, and operated in a stable, established industry. Buffett paid for the acquisition with Berkshire stock, a decision he would later describe as being enormously costly. So what exactly went wrong? The core issue was competitive durability. Dexter faced growing pressure from lower-cost international manufacturers. Margins compressed, and the company's economic advantage, if it did ever have a durable one, proved fragile. The business deteriorated far faster than expected, and Buffett later referred to this as one of his worst investments. And here we find our first lesson. Graham taught us to demand a margin of safety. But the Dexter episode reminds us that safety is not found merely in accounting measures or the purchase price. A stock can appear statistically cheap. It can trade at modest multiples. It can even produce respectable earnings. But if its competitive position is eroding, then that apparent cheapness offers very little protection. Cheapness without durability is not value. It is risk disguised as opportunity. And this recognition that competitive advantage matters so profoundly would go on to shape Buffett's later evolution as an investor, moving him yet further away from purely statistical bargains and towards businesses with enduring economic moats. So let's now move on. For decades, Buffett avoided airline stocks. He once remarked that investors might well have been better served had early aviation been halted altogether. Such was the industry's long record of capital destruction. He once famously remarked that a far-sighted capitalist at Kitty Hawk back in 1903 should have shot down Orville Wright. The industry suffers from high fixed costs, fierce competition, and sensitivity to economic cycles. Yet in 2016, Berkshire made substantial investments in major US airlines. The reasoning seemed logical enough. Industry consolidation had reduced competition. Capacity discipline appeared improved, and profitability was more consistent than in previous decades. But then along came 2020. Global travel halted almost overnight. Revenues collapsed, and even the most established carriers required external support. And Buffett was forced to exit his airline positions at a loss. This episode teaches us something subtle, yet quite critical. Cyclical businesses may appear to be structurally improved, but they remain vulnerable to forces beyond the management's control. Geopolitical events, economic contractions, even global health crises. The margin of safety in such industries must be substantial enough to withstand even these extreme scenarios, and not merely ordinary downturns. And Graham emphasised the management of risk over the pursuit of return. Here we see how macro vulnerability can undermine even a rational thesis. The lesson here is not that airlines are uninvestable. It is that cyclicality never truly disappears. It merely lies dormant until conditions expose it. And value investors are forced to respect that reality. Let us now turn to a different kind of mistake. Not one of structural decline, but of delayed reaction. In 2006, Berkshire built a significant position in Tesco, the British grocery chain. It appeared to fit comfortably within a value framework. A strong market presence, steady cash flows, and a reasonable valuation. However, accounting irregularities later emerged. Competitive pressures intensified, and the company's economic position weakened. Buffett acknowledged that he reacted too slowly. He relied too heavily on management assurances, and did not exit the position as swiftly as the changing facts warranted. This brings us to an often overlooked principle in Graham's philosophy: flexibility. Investment is not a static commitment to an idea. It is an ongoing assessment of changing facts. When the evidence changes materially, rational investors must be prepared to revise their conclusions. Conviction is valuable and often admirable, but stubbornness is neither. The Tesco experience reminds us that value investing is not passive endurance in the face of deteriorating fundamentals. Patience must be paired with vigilance, and discipline must include the willingness to admit error. Not all mistakes involve buying the wrong company, of course. Sometimes the mistake lies in failing to recognise one. For many years, Buffett avoided investing in Amazon, led by Jeff Bezos. The company reinvested aggressively. Reported earnings were modest relative to valuation, and traditional value metrics did not signal obvious cheapness. From a classic Graham-style lens, the company did not appear to be compelling. Yet Amazon possessed powerful competitive advantages: scale, logistics infrastructure, network effects, and ultimately dominance in cloud computing. Its intrinsic value was compounding beneath the surface. Buffett later acknowledged that he underestimated the durability and the long-term economics of the business. Here the lesson is evolutionary. Value investing is synonymous with the purchase of future cash flows at a discount to their intrinsic worth. Yet when those future cash flows are expanding rapidly, traditional value metrics can obscure opportunities. But Graham taught principles, not rigid formulas. The economy evolves, business models evolve, competitive advantages evolve. So too must the investor's analytical lens. Finally, we come to an earlier phase of Buffett's career. In his partnership years, he closely followed Graham's cigar butt approach, purchasing deeply discounted, often mediocre businesses, trading below liquidation value. And these investments frequently worked, but they required continual turnover. Buy cheap, wait for prices to recover, sell and repeat. Over time, Buffett realised something significant. Even if these investments produced acceptable returns, they lacked scalability. They consumed time and attention, and they offered limited long-term compounding. Influenced by Charlie Munger, Buffett shifted towards acquiring high-quality businesses at fair prices. This philosophical transition transformed Berkshire's trajectory. The lesson here concerns opportunity cost. Owning a mediocre business, even cheaply, can prevent capital being allocated to exceptional enterprises capable of compounding for decades to come. Time is the value investor's most powerful ally, and superior businesses harness that time far more effectively than ones that are simply statistically cheap. When we step back from all this, a pattern becomes visible. Dexter teaches us durability. Airlines teach respect for cyclicality. Tesco teaches adaptability. Amazon teaches intellectual flexibility. And the cigar butt era teaches us about opportunity cost. Yet none of these mistakes arose from speculation or recklessness. They arose from rational analysis, confronted by imperfect foresight. And this is the essence of investing. Graham never once promised certainty. He promised a framework, one grounded in rationality, margin of safety, and emotional discipline. Buffett's mistakes do not contradict Graham's teachings. They merely serve to eliminate them. So what can we, as modern value investors, take away from all this? First, that durability matters more than apparent cheapness. Second, cyclicality demands humility. Third, vigilance must accompany patience. Fourth, intellectual frameworks must evolve alongside the economy. And finally, time. When paired with quality, is the engine of compounding. Value investing is not static. It is a discipline of continual learning, reflection, and refinement. Even the greatest practitioners adjust their approach over the decades, strengthening their understanding through experience. And perhaps that is the most reassuring lesson of all. Mistakes, when managed intelligently, need not derail long-term success. They can, instead, sharpen judgment and reinforce principle. And on that note, we draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed it, and that this exploration into Warren Buffett's mistakes has reinforced an important truth at the heart of value investing. That intelligence in investing lies not in avoiding all error, but in learning from it, adapting and remaining disciplined in the face of uncertainty. If you have enjoyed this episode, do consider subscribing or adding to your playlist. That way you'll be reminded the instant a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.